Hello, welcome to another video roundtable, this time on Asia Corporates. My name is Buddhika Piasena, Head of Asia Corporate Ratings, and I'm joined by three of my colleagues today. Ying Wang, Head of Asia Energy and Utilities and China Research, Kalai Pillai, Head of North Asia Industrials, and Vicky Melbourne, Head of South Asia Industrials. Ying, let's start with you. China is starting to see a slowdown. Credit markets had been fairly tight. We've seen increase in number of defaults on the onshore market. How do you see the liquidity position and risk for corporates going into 2019?
We expect corporate defaults to continue to increase in 2019 due to high refinancing pressure, the government's greater tolerance for defaults, and relatively tight credit availability despite the government's macro easing measures. If we look at the first half of 2018, onshore corporate bond default rate was about 0.2%, which was lower than 0.4% in 2017 and 0.7% in 2016. The decline has reflected an improvement in the commodity sector and a recovery of commodity prices. On top of that, we have seen that the government taken a crackdown on the shadow banking activities, which led to a contraction of liquidity and credit in the overall financial system. This has led to a number of credit events in the first half of this year. Most of the credit events have been triggered by liquidity shortfalls rather than business fundamental reasons. And looking at 2019, we have seen the government injecting liquidity into the system as part of the macro policy and easing efforts to counter the impact from the trade war tensions. But we think that the overall credit conditions are likely to remain relatively tight, especially for the private sector, which has benefited less from the macro easing policies. This is because financial institutions' lending capacities continue to be constrained by much tighter regulations on shadow banking, and their cost of funding has increased. And financial institutions are getting more cautious from a risk perspective, given the economic uncertainties and volatilities in the global financial markets. So the private sector, I think, will continue to be more vulnerable to liquidity crunches and external market volatilities. So for us, monitoring corporate liquidity continues to be a critical part of the analysis in 2019.
Okay. Kala, you head up a pretty diversified portfolio in China, our largest coverage from property to consumer to industrial.
Yeah.
What sort of rating trends have you seen, and how do you sort of extrapolate that into 2019?
Okay, I think this is probably, having a large portfolio means there are too many trends. To simplify that, it's a bit harder, but I'll leave the discussion about property to later because we're going to talk about that. But amongst the others, it's not a particular sector that's being affected. It's more profiles of companies. It's following on to what Ying said about private companies with poor liquidity. I think that's basically the main issue. They're having problems refinancing. As you know, many of these Chinese companies tend to rely quite a bit on short-term financing than they should. That has been fine for many years because banks always lend to them. Banks always rolled over their debt. Now that is not a certainty anymore. So when there's doubt, they're starting to see some challenges. So it's really boils down to that. The other problems we find are idiosyncratic stuff like corporate governance. And I don't necessarily mean like, management running away with the money or anything like that. It's more companies that have guaranteed debt of other companies. Even if they don't have to sort of make good on that, their own ability to access funding from the banks and capital markets are being curtailed. So it is this corporate governance and complex group structures and relationships that are hurting. To summarize, right, the where we're going to see negative, where we've seen negative credit actions this year and where we will continue to see negative credit actions next year would be with privately owned companies with complex group structures and poor debt maturity profiles.
Okay. Ying, you mentioned trade tensions. How significant is the impact on China corporates from trade tensions and tariffs?
Well, China's exports to the U.S. account for about 15% of the country's total exports. So that number per se is not that significant. And if you look at Fitch's rating universe, export revenue account for less than 10% of the company's total export revenue. And exports to the U.S., I would think that number is even smaller. So the direct impact from trade wars is not that significant. But I think the wider and deeper impact is on two dimensions. One is on corporate investment appetite, and the other is on the funding market conditions. So I think given the trade war tensions escalating and economic uncertainties, corporates' investment appetite could be curtailed, both foreign corporates and domestic corporates, and that could impact economic growth. And secondly, investor sentiment could weaken significantly given the trade war tensions and ongoing uncertainties. And we have seen the Chinese government injecting liquidity to address this particular issue. But we have to bear in mind that the Chinese government also is keen to balance the need to contain systemic risk with the need to boost growth. So despite the ongoing efforts to provide more liquidity, I don't think the Chinese government will go back to the old days of massive liquidity injection. So the ongoing campaign to regulate the shadow banking activities will continue. As I mentioned earlier, that would put limit on banks' capacity to lend, especially to the private corporate sector. So with that, I think from a funding perspective, the impact from the trade war is likely to be even greater.
Right. And we can't talk about China without talking about China property.
Yes.
What is the industry outlook for next year, and what type of risks should investors be looking out for?
Okay. I mean, China property obviously is the largest segment of our coverage. This year, following on with last year, has been the best years for the sector in terms of sales. This year, the sales are, going to be, in terms of volumes, going to be around 1.5 billion square meters. Now, that's well above the long-term trend that the market can support, which we think should be around 1 billion square meters. So the market, we think, should come down in terms of volumes, and prices are kind of like controlled. So overall, sales should be coming down next year, right? How much will it come down? Will it drop to $1 billion square meters? No, it's going to be more a gradual decline to that level. So the healthy sort of decline that we expect is around 10% next year, maybe a bit more. But anything more than that, I think the government would be concerned and would use regulatory measures to, prevent that from happening. As you know, they're restricting sales right now, so they can, loosen that up a bit, so to allow more sales. But I think that would be the right direction for the market if the sales fall about 10% or a bit more than that. Just to add on to that, in terms of rating implications on the companies that we rate, some of the smaller companies that we rate, typically rated in the sort of the single B rating category, in the last 2 good years, they haven't been able to deleverage, even if it's such good sales and market. That's just because of the competitive dynamics in this market, which has become highly, highly competitive. So if they couldn't deleverage in these good years, if next year there's a decline in the market, they will really struggle, right? I think that is our main concern. We've already started taking some negative action in that rating category. Some of them are on a negative outlook, so perhaps more negative actions there. The larger developers, typically rated in the double B and investment grade territory, they probably will benefit from a decline in the market because the competitive dynamics will improve in their favor. So if that happens, I don't think we're going to take much positive rating actions. It would be hard to do that in a declining market, but I think there will be more stability in the ratings of the higher rated companies.
Right. So you said there could be a large number of small players finding themselves in financial difficulty. How do you think that would lead to consolidation? Do you think there'll be more M&A, larger players buying the weaker ones? Or do you think it's going to be resolution through other means?
Well, acquisitions, the large players have no incentive to acquire small ones. They want the small players to exit the market. So the small players have interesting land bank or inventory that they are interested in. They might purchase that selectively if the price is right. So if the small players, in financial difficulty, if they're distressed enough, they might, be willing to let go of this good inventory, at attractive prices for the large players. So that might happen. But M&A, it won't happen just because the large players do not want to be, they don't want to deal with the debt profile, difficult, liquidity concerns in the smaller players. They don't want that trouble. They just want the inventory. So that's the way it's going to get resolved, not through M&A.
Interesting. We'll turn over to you, Vicky. Local currency. Indian rupee and Indonesia rupiah has weakened quite a bit against the US dollar. How does that impact the industries and the companies we rate in these two markets?
We'll start with Indonesia, and in particular, if you focus across the Indonesian property developers, and again, that forms our largest portfolio from a coverage perspective, and that's where the greatest exposure is to US dollars. Across the rated entities in our portfolio, about 60% of their debt is US dollar denominated. So if you sort of just focus on the Indonesian property developers, I mean, they're already struggling at the moment with weak demand. For the first half of the year, sales were 33 trillion, which is roughly sort of 17% down from the previous year. So they're already struggling with weak demand. And then on top of that, they're facing higher construction costs with raw materials priced in US dollars. So they're facing higher construction costs, and then you overlay that with a significant exposure they have to the US currency as well from interest rates. There is that real potential of weakness there in terms of their cash flows further contracting. Fortunately, though, a lot of them have learnt from the past, and also a function of regulations as well. What we're actually seeing is a lot of them are hedged. Some have been very conservative in terms of both hedging both their principal and also their interest. But predominantly what you will find is that they're well hedged. And we've stress tested their portfolio in terms of the hedges that they have in place. And we think certainly from a currency exposure, they're probably well placed, predominantly. The other benefit that they have is that most of the maturities are 2021. So there is sort of time before these bonds do come up for maturity. So there's that comfort level there as well. There are, however, some across the portfolio that are unhedged. So they're the ones that we will see where we see the greatest risks. In terms of the other challenge that they also have as well, the Indonesian property developers, is we've got presidential elections, both in India and in Indonesia. For the Indian property developers, we think that would also further delay any investment in large ticket items as property. So certainly we don't expect any real pickup in demand until sort of late end of 2019. As for the across our Indian portfolio, not a lot of them across our universe actually have US dollar debt. Most of their debt is local currency debt. So fortunately, certainly from a a FX perspective, we don't see too many risks, but certainly rising interest rates, they're all exposed to that. And where we see potentially the most weakness from a sector perspective are those across where there's more the business to consumer exposure. So they don't have the ability to pass on any rising costs. So particular sectors that we're concerned about, your chemicals, your fertilizer companies, your airline companies who already are facing, it's already a very competitive sort of sector, and also your cement companies are most exposed.
Right. Let's talk a bit about commodities. The last 2 years, we've seen commodity prices increase, so it did help financial profiles of a lot of the upstream companies. But demand and consolidation factors also meant that some of the downstream companies also benefited in the last 2 years. But with China slowing down, for example, housing demand, do you think there's a lot of downside pressure on commodities? Maybe Kalai, you can start.
Well, not necessarily in China, because I think one of the big change in the metals and mining sector in China in the last maybe just the 2-3 years is the supply side reform. The supply or capacity has reduced significantly, mostly through the shutting of older plants that are less, using processes that are less environmentally friendly. So because of this supply side discipline, a slight decline in demand won't affect prices too much. Maybe prices may come down, especially in steel, may come down from where they are now. This year probably has been one of the best years for the steel companies in China, right? Maybe they'll come down a bit more, but we are not going to go back to really difficult years that we saw just maybe 2-3 years ago. We won't go back there because supply side reform has really worked in China finally.
Right. And Ying, you look after energy and related commodities. What's the outlook for thermal coal and oil and gas?
Yeah, I would agree with Kalai's view. I think coal prices have stabilized, and I think if there is going to be some form of correction, it is likely to be moderate. We know the Chinese government has set sort of a comfortable price range, a band for thermal coal prices. And when prices sort of exceeded the upper end of the band by a bit too much, we have seen the Chinese government directing the state-owned coal producers to ramp up production. And they also loosened up restrictions on imports of seaborne coal. And when coal prices started to weaken, we think there are tools available for the government to support the prices, such as limiting the number of working days for domestic coal mines, or they can tighten up environmental control on the sector. So there is a way for the government to sort of manage prices and smooth out volatilities from the supply side.
Thanks all for your contributions.
Welcome.
And thank you for watching this video.